Hi everyone, it's Jab out with another video. Today I'm going to be talking about BYND Meat. Pretty famous stock, makes plant-based burgers, plant-based meat alternatives essentially. When it IPO'd, it could do no wrong and was once a $230 stock with a ton of hype behind it. That was a few years ago now. It now sits at $50, having dropped 68% from its yearly high of $157. I want to try and establish, is it undervalued from here, or has it still got room to go down, and is the stock complete garbage, or is it still salvageable? Because the key attraction for a business like this, for plant-based meat and pea-based meat, is that the total addressable market for these is absolutely enormous, and theoretically is the global meat market, which is a $1.4 trillion market from BYND Meat's estimates. In reality, is likely to be a fraction of this, maybe a tenth. I believe 9% or so of the population is vegan in developed countries, so maybe a tenth of this is possible. The US meat market alone is $270 billion. Even a tenth of this for plant-based products would be $27 billion, more than 50 times BYND Meat's 2021 revenue. They're making solid progress towards scaling their operation, 30% increase in manufacturing capacity, and they are now in 130,000 outlets worldwide with good traction this year, and they've made some good partnerships. Key concern is obviously revenue growth is slowing dramatically. 74% compound annual growth rate over the last 4 years, but that's sandbagged massively by only 14% year-over-year growth in 2021. Really unimpressive, severe deceleration, and is a bit worrying, so I want to dive into it a bit deeper. In the most recent report for Q4 2021, the revenue is actually down year-over-year, which is extremely worrying. They blame the failings basically on increased competition and decreased demand in the wider industry. Either way, extremely worrying for the business. Profits are less of a concern to me. Profits down 51%, gross adjusted profit. Manufacturing costs, logistics hitting everyone, but the revenue failure is absolutely huge. I mean, blaming competition is really not good enough as far as I'm concerned for a growing business. You should be creating a moat, which I don't think BYND Meat has much of. And of course there's competition, because this is an enormous market. There's competition from Impossible Foods, from Tyson Foods, from Tattoo Chef, from tons of own brand and artisan and niche competitors, and it's only going to get more and more. So this is extremely worrying that they're concerned about competition. I'm citing this as a failure very early on. As you can see from the graphs at the top, the key failing for the revenue this year and why it was only 14% was the US retail revenues were actually down quite severely year over year from $264 million to $243 million, compared to food service, which is for the restaurants essentially, which is up nicely from $61 million in 2020 to $76 million. Say up to actually bounce back. It's only slightly up from 2019, but as you can imagine, there's severe losses from 2019 when many of these restaurants were shut down. Internationally, they're doing really well. They're getting a lot of expansion here, getting a lot of new partnerships, as you can see just below, some select customers, Sainsbury's and Starbucks being two of the big ones. The US food revenue and food services, they're with a lot of good brands here: McDonald's, Pizza Hut, Panda Express. Of course, Impossible Foods are with Burger King, and there is competition here as well, so this is a tough space. US retail, they're in all the supermarkets you would expect: Walmart, Sam's Club, Kroger, Costco, Target, any supermarket you can think of, they'll be in there, of course, but so is it most other competitors, and so crucially is the supermarket's own brand increasingly. So it doesn't surprise me that this is down. I'm liking the partnerships, huge for a young business like this, and they're going to need to continue if they want to get any sort of brand equity, which is the only way I can really see this happening. Of course, US retail is the biggest failing of the year. They blame an element of this on stocking up during 2020 on freezer items, essentially. That's why it got so high. So if you look at from 2019 to 2021, if you ignore the 2020 massive boost, this is kind of reasonable, but I don't think this is a good enough excuse for me. Stocking up is just not going to get you by. On Wall Street is not going to like if your excuse is that you had too much sales in 2020. People aren't eating your food, essentially. That's not good enough as far as I'm concerned. Getting more items in restaurants is good. Getting the name out there. If people like it in restaurants, perhaps they'll use it for their own recipes at home and go looking for it in supermarkets. But again, I'm not seeing enough here. Next, I want to briefly look at the company's own outlook. Of course, this is the company's prediction, so take these with a pinch of salt, of course. Management predicts revenue in the region of $560 to $620 million. That'll be a 21 to 33% growth year over year. This will be, of course, a return to better form, re-accelerating from just 14% growth the year prior. Company has a history of missing guidance, so I, for one, am not taking this as a definite, but it is definitely a win that the stock desperately needs. They see this as a continued reduction because there's going to be an increased demand on labour availability, continued supply chain and disruptions, and demand is going to be a bit all over the place, they believe, perhaps if there's local lockdowns or anything like that. But again, very murky waters going forward. I'm not so convinced that they can do that 33% number. Only time will tell. Taking a look at the balance sheet. Balance sheet does not fill me with confidence in this business at all. They have around $1 billion in debt, $600 million in cash. Still losing money, so this cash is going to get depleted. Not to mention the capex for expanding manufacturing in the future. It's going to take cash, and I'm worried that there may be some dilution needed in the future. Just $600 million in cash. They're predicted to lose $143 million in EBIT next year. This is concerning. Analyst expectations do not see profitability for at least the next few years, still having a negative EBITDA in 2023. Of course, these are just expectations, but Beyond Meat is scaling and they are going to need cash to scale, so I'm a bit concerned that dilution might be a problem. Revenue picture is optimistic, $606 million, which is below their own estimations in 2022, then a big uplift in 2023, $780 million, but again, analyst expectations this far out are often sketchy, and these could just be older analyst expectations. I'm not entirely sure. I'm still not impressed with the business's finances at all. The market cap's now around $3 billion, $1 billion in debt for a $3 billion company that's young, loss-making, quite a lot as far as I'm concerned. I think the price-to-sales ratio, even though it's came down a ton, is still quite rich, 6.7, no signs of going profitable anytime soon. I'm not really sure why it justifies this with 14% growth, bad gross margins, but like loss-making and higher competition with very little moat. Even if it's the cheapest it's been for a long time, I think this price sales ratio has some to go, and the stock could do with shedding some weight. You've probably got from the tone in this video, I'm quite bearish on this company and I'm concerned with its near-term future. I did once like the stock, I was interested in it. I did some deeper diving about a year ago and I was kind of interested in it, but I just couldn't get on board with the valuation then, when, as you can see, it was probably about 3 times as high as it is now. So a price sales of 20, I definitely wasn't interested in the company. Even now, a price sales was 6 with what has happened since. With the company's finances getting considerably worse, the revenue deceleration is severe. I'm concerned about this company's future. An acquisition is definitely possible. It's now sitting around $3 billion market cap. If you're a bigger company, you wanted to add this to your portfolio, perhaps something like Tyson Foods, I could fully see you doing this. Maybe a Unilever or a Procter & Gamble, something like that. Definitely an acquisition is possible, but I just can't buy companies if I think an acquisition is the best case scenario. This company could absolutely bounce back, but I think the next few years are going to be rocky. They're not going to be profitable anytime soon. Revenue's all over the place. They're struggling to do anything. I mean, this 20%, 30% revenue will be best case scenario this year from their expectations. That is already a ridiculously large deceleration from just 2018, 2019 numbers. So this business is going in the wrong direction for me. And even though the market is absolutely enormous, the competition is getting harsher and harsher. Impossible Foods are basically the same company as Beyond Meat, and yet there is no discernible moat for either of them, other than maybe brand. But if they're essentially the same food, like, do you care which brand of sweet corn you buy, for example, or do you just buy the cheapest one or buy whatever? I can't see any real moat here. Of course, I could be wrong, and maybe Beyond Meat will be the tastiest burgers in all the land. I have tried the McDonald's Beyond Meat version, and I've tried the store-bought version, and they weren't particularly special. They were okay. I've tried other versions of the pea protein-based burgers, and they were fine as well. So I'm not really seeing any difference in that. So for me, I don't think there's any brand power. So I'm not really seeing any moat here. And if I'm not seeing moat, I'm seeing tough competition. I'm seeing decrease in revenue. Listen, absolutely stay away from this company. Maybe I'll look back on it in a year or two, because I really like the vegan meat space. Perhaps there are other companies I'd be more interested in. That'd be interesting if you let me know in the comments. Another company I'd like to analyse, perhaps Tattoo Chef or something like that. It's not really looked at that company. Of course, don't take any of this as financial advice. You should do your own research and due diligence. I'm not a financial advisor. If you're enjoying the video, please like and subscribe and help the channel grow. And I'll see you again next time.